Now we've gone through the exciting world of chapters 3, 4, and 5, equity and fixed income. It's now time to turn our attention to chapter 6, which is titled Investment Returns. It builds on chapters 3, 4, and 5, especially some of the ideas in 4 that discuss the various yields. So let's get started. Now chapter 6 covers information from section 3 of the SIE outline. Now section 3 in totality is approximately 31% or 23 questions. This is only a component of that, and this is covering section 3.1.2 of the SIE outline. So, what are the main topics that we are covering in chapter 6? There are 5 of them. First, the return on investments, how we calculate the various yields or returns on debt and fixed income, or debt or fixed income, as well as equity investments. 2, price versus yield. We're going to build on the relationship of chapter 4 and discuss some new terminology. Item 3, cost basis. When we buy and sell, when we do that, do we have a gain? Do we have a loss? So we need to talk about cost basis versus what's called a capital event. 4th, measuring the various returns. We've heard returns of the yield return, the risk-based return, the total return. Let's discuss that in the formulas based on that. And last but not least, our indexes and averages, so we can talk about what's referred to as benchmarks. How did one do? You know, if we return, our return is 10%, how is that based upon some index or average? Now first, regarding equity investments. The return on equity investments primarily through 2 things. 1, the dividends. 2, the capital gains, which we'll discuss later. So shareholders, as we talked about in chapter 3, and a little bit even in chapter 1, that dividends or cash dividends is the main return that one gets or receives on equity investments on an annual basis. So let's build on that. And remember, as we discussed earlier, dividends are not guaranteed and they are determined by the board of directors. Now, dividend dates. There are going to be 4 of them. 3 are determined by the board of directors, 1 is not. First, the declared date. Now, all this happens kind of within a month. So the declared date is when the board of directors says we are going to pay a dividend of 50 cents, and they declare it. And then it becomes what's referred to as a liability, saying, I'm going to pay you something. I'm simply not going to pay you today. I'm going to pay you in a couple of weeks. 2, the payment date. That's my favorite date. Don't tell me how much you're going to pay me, simply pay me. That's the date they distribute the dividend. They make the actual payment. 3 is the record date. Now, the record date is very important. It determines for ownership purposes. In chapter 2 and chapter 1, we talked a little bit about clearing and things like that, that back office function. We're going to discuss that more in detail as we get to the record date. In order for someone to receive the dividend, they have to be an owner of record as of the record date. Those 3 dates are set by the corporation, actually the board of directors. Now, in order of occurrence, it would be first declared, then record, then payable or payment date. Now, the 4th date is one of the most important dates, and that is not determined by the board. That is called the ex-dividend date. Now, the preface EX means without. So what we're really saying is, when did the stock begin to trade without the buyer receiving the dividend? And that is on the X date. Now, regular way settlement is normal business, and that is currently, with corporate securities like stock, 2 business days. So if I buy a stock today, my name appears as owner of record 2 business days from today. So if today is a Tuesday, if that is the day I buy it, Wednesday is day 1, Thursday is day 2, it would settle on Thursday. Because the settlement date is 2 business days after the purchase date or trade date, the ex-dividend date is 1 business day prior to the record date. And on that day, the ex-dividend date, the stock begins to trade at a reduced price because if I'm buying the stock, I'm not receiving the dividend. So for example, If the stock is currently trading at 40 and the dividend is $1, if I buy the stock on the X date, I'm buying without the dividend, I'm not receiving that $1. The market generally changes the price of that security to $39 versus the old price of $49. And that's just a function of what the market does. Then as people buy and sell, that stock price could go down, it could go up. But generally speaking, on the ex-dividend date, the market price is reduced by the full amount of whatever the dividend is. Now, one more item before we move on to the next slide. Besides regular way settlement, there's also something called cash trades or cash transactions. And that is where someone wants to buy a security and be the owner of that security on the same day. So cash trades settle the same business day, where regular way transactions settle in 2 business days. Now that's going to become important when we discuss the next slide. So in summary, if we add the ex-dividend date to our mix, if we were asked the order of events when it comes to cash dividends, and those 4 dates are listed, it would be declared, X, record, and payable. Let me repeat that. If all 4 of these were included, and you were asked the timeline, declared would be 1, X would be 2, record would be 3, and payment would be 4. And one added point again, the ex-dividend date is not determined by the board, it's a function of the settlement date. Now let's look at an actual example. On this slide we have the month of May. The record date established by the board of directors is Thursday, May 12th. So when would be the ex-dividend date? Well, the slide before said 1 business day prior to the record date. So if we looked at that, that would be the 11th of May, the day before. Now, why is that the case? Here's why. And please listen to this very carefully, because this will come to be important in other questions as well in other chapters. If I buy the stock on the 11th, it settles in 2 business days. So if I buy it on the 11th, it would settle on Friday the 13th of May. Well, they open the ownership books to see who's an owner on the 12th. Anyone who's an owner as the close of business on the 12th receives the dividend. If you're not, you do not receive the dividend. So if I bought it on the 11th, they wouldn't know about me to the 13th, therefore I could not receive the dividend. However, when is the last day I could buy the stock and still receive the dividend? Well, that would be Tuesday, May 10th, because if I purchased the stock on Tuesday, May 10th, it would settle on the 12th and I would be an owner of record. So let's go through a few possible examples. The trade date is May 9th, Monday. It settles on the 11th on or before record, therefore the buyer would be entitled to the dividend. What if the trade date is Tuesday, May 10th? Well, if the trade date is Tuesday, May 10th, it's going to settle on Thursday, the 12th. Therefore, the buyer again would be entitled to the dividend because they're buying it before the ex-dividend date. Next, May 11th is the trade date. Settles the 13th, the day after the record date. In that case, the seller would be entitled to the dividend. And last but not least, a transaction done for cash settles same business day. May 11th, a trade done for cash would settle on the 11th. Therefore, the buyer would receive the dividend. One more thing, if on the examination they use the term trade date or settlement or things like that, and they don't specifically mention cash trade, please assume they're referring to regular way transactions or regular business. Okay, so let's take this same example and add one more concept. And that additional concept is called the due bill. And you're going to, interesting is, a due bill is actually a check. You'll see what I mean in just a second. Okay. So from our previous example, we knew that Thursday, May 12th was the record date. And then Wednesday, May 11th was the ex-dividend. So that remains the same. Let's discuss the concept of the due bill. Life is not perfect. And what I mean by that is that sometimes, even though the trade is supposed to settle a certain date, because of back office issues, it may not. So what if the buyer purchases the stock before the X date, but this transaction doesn't settle to after the record date. Well, the buyer was entitled to the dividend, but they didn't receive the dividend. So the seller receives something they weren't expecting to receive, nor should they receive, and the buyer doesn't receive that. That's what the concept of the due bill is. And what a due bill simply is a check from the seller to the buyer to make the buyer whole. So let's say the dividend is supposed to be $1. The seller receives $1. They weren't entitled to that dollar. They write a check out. It's actually a transfer payment at the brokerage firm for $1. That money goes to the buyer. The buyer is now whole. But for the purpose of the exam, in case the term due bill is mentioned, it is what the seller owes the buyer if the buyer was entitled to something and the seller was the one that actually received it. Next, let's going to do an activity. Take a minute to answer the question in your workbook. Here's the scenario. A corporation has declared a cash dividend on June 1st, payable on July 25th to stockholders of record July 12th. Which of these statements is or are true? Which of these statements is or are true? 1. The stock trades ex-dividend on Wednesday, July 11th. Is that true or not true? 2. The seller is entitled to the dividend on a trade executed on Tuesday, July 10th. 3. If securities are not delivered by July 12th, a due bill must accompany the delivery. And last, a cash trade can be done as late as July 25th in order for the buyer to receive the dividend. Let's look at those 4 statements. Which one of those 4 statements is true or true? The correct answer or answers is 1 and 3 are true. Yes, the ex-dividend date is Wednesday, July 11th. Now, why is 2 incorrect? Well, 2 is correct because July 11th is the X date, and therefore the seller would not be entitled to the dividend. It would be the buyer that would be entitled to the dividend if the trade was done beforehand, which would be July 10th. Now, also 4 is not true because a cash trade cannot be done up until July 25th. July 25th is the payment date. A cash trade can be done up to the record date of July 12th. Notice how the details are very important. Because if item number 4 had July 25th, which it does have, it's incorrect. If it had July 12th, then it would be correct. Moral of the story is make sure that you answer these questions very, very slowly on the actual examination and try to do it on our practice test because you might understand the concept but get the question wrong because you read it too quickly. Very important point to make. Now, companies pay you cash dividends when they have the cash to pay you. In some cases, the company may not have or doesn't want to pay you a cash dividend. This does not happen that often, but it could appear as a question on the examination. And that is referred to as stock dividends. You're receiving extra shares of stock versus cash. What is the impact of stock dividends, and what is the tax treatment of stock dividends? Well, the impact of stock dividends is there is no economic gain or loss, doesn't change the amount of capital the issuer receives, and whatever percentage ownership you owned before is the same exact percentage as afterwards. Stock dividends are usually paid out as a percentage, 3%, 4%, 5%. So if you own X number of shares and receive a stock dividend, you're getting X percent more. But you're not gaining anything of real value because you're receiving more shares, but the price per share will be adjusted accordingly. And we're going to see an example of that in just a few minutes. Now, the treatment of stock dividends in terms of taxes. Since you're receiving additional shares, but you're not receiving any additional compensation, there is no taxability as either income or capital gain. But your basis or cost basis per share would be adjusted because the total amount you own remains the same, but the number of shares you now have increases. The best way to show you this is through an example. So let's go through the next slide and do an example of a stock dividend. An investor owns 100 shares of XYZ, currently priced at $60 per share. The company declares a 10% stock dividend. Let's look and see how this happens. Before the dividend, you owned 100 shares at $60 a share, so the value of what you own is $6,000. That will not change. The pie will remain the same, but it might be cut into more pieces. After the dividend, you're going to own 10% more shares. 10% of 100 is 10. Add the 10 to the 100, you now own 110 shares. To calculate the cost per share, which is now $54.54, the best way of doing it is to divide the total amount that you own, which is $6,000, divide that by 110. 6,000 divided by 110 shares equals $54.54. Again, the total value does not change and equates to $6,000. There is no increase in the total value of what you own, but there is an increase in the number of shares. Now, remember, if the share price goes back up to 60 at some future point in time, the value of what you own will be greater. But that has to happen. Now, how do we calculate the current yield for equities? Well, the current yield for equities, or dividend yield, or yield on the equity, is found by taking the annual income and dividing that by the current market price. As the market price changes, the current yield will change. Make sure you remember it's based upon an annual dividend. So even though dividends are paid quarterly, the amount of the dividend yield is based on the annual dividend. Let's look at an example. A stock is currently trading at $40 per share and is paid a quarterly dividend of 30 cents. The current yield for this stock is, the formula is found by doing the following. Take the annual dividend divided by the current market price. The annual dividend would be 30 cents multiplied by 4 divided by 40. So $1.20 is the annual dividend divided by 40 equals a dividend yield of 3%. Not a bad return. Make sure you remember to read the question carefully on the examination. Are they giving you the quarterly dividend? If so, multiply by 4. If they give you the annual dividend, part of your work has already been done. Take the annual dividend. Make sure you remember to do this because the choices are going to be based upon, especially the incorrect ones regarding this, would be based on a quarterly. So there might be a wrong answer based upon you doing quick math of taking 30 cents, dividing it by $40, and getting one of the incorrect choices. You pick it and think you're right. Make sure to read the question very carefully, and if there is a quarterly dividend, make sure you multiply by 4 prior to doing the math. Let's do another exercise now, and this exercise will be a true-false. Let's go through that. Please make sure you look at your workbooks. Number 1. A stock dividend changes the overall value of one's portfolio. True or false? False. The value doesn't change. You simply own more shares at a lower value per share. Number 2. The cost basis of shares is reduced after a stock dividend. Is it reduced? True. As we saw in our previous example, the cost basis went from $60 to $54.54. 3. A stock dividend is taxable in the year it's paid. False. There is no tax. The only time there would be a tax is if you received the stock dividend at some future point in time, you sold the shares, you would have a capital gain or a capital loss depending upon what you sold it for versus the adjusted cost basis. So in our previous example, If we sold the stock above $54.54, it would be a gain. Below would be a loss. Lastly, if a cash dividend remains the same, the current yield of the stock will increase after a stock dividend is paid. Think hard on this one. This is tricky. The amount of the dividend per share is going to remain the same after a stock dividend. What happens? The current yield will increase. Why? Because you'll receive the same amount of dividend per share, but the number of shares would increase. So for in our example, the number of shares increased from 100 shares to 110 shares. If the dividend per share remained the same, the value of the dividend would increase, and therefore the price would also be adjusted as well, and therefore the yield would increase. Now that we've discussed the return on equity investment, let's turn our attention to the return on bond investments. Now, bond prices are primarily influenced by what's called market or the general level of interest rates. We know from previous examples there's an inverse relationship between interest rates and bond prices. And bond yields and market interest rates move in the same direction. So the general level of rates increase or decrease causes bond yields to increase or decrease. And bond prices move inversely. In order to calculate the various returns, you really need two things. One, what is the amount of interest payable per year? And remember, we generally get paid on bonds semi-annually, every 6 months. And what is the current market price of the bond? So those are the two things you really need. There are 4 main yields of the bonds. We've discussed 3 of them in previous examples in Chapter 4. We're going to build upon that. The nominal yield is same as the coupon rate or the annual return, and that is fixed for most securities. I know you could have variable or floating rate securities, but for this example, we're going to assume a nominal or fixed rate of return. 2, the current yield builds upon the nominal yield, uses that annual interest payment, and you divide that by the current market price, not the price you paid. You might have paid $900, and now the bond's selling for $950. It's based upon $950, not $900. Now let's look at how to calculate current yield in a few different examples. Now the formula for current yield is a very straightforward, simple formula. The annual interest rate, or the amount of interest you're going to earn, divided by the current market price. Let's look at some examples. There are 3 examples, 3 different nominal yields, 3 different bond prices. Let's do the calculation and calculate the current yield. Number 1, 8% return is $80 per year, current market price of $1,000. That's pretty basic. Current yield would therefore be equal to 8%. Number 2, nominal yield of 9%, current bond price of $1,125. We take the annual interest of $90, divide that by the current market price of $1,125, equals the same current yield of 8%. So notice, a higher nominal yield and a higher price equates to the same current yield in this example. Lastly, if the nominal yield is 6.5%, bond price is $812.50. Let's do the math. Annual interest is $65, 6.5% of $1,000, divided by the current market price of $812.50, equals, again, a current yield of 8%. So the first one is a bond trading at par, the second one is a bond trading at a premium, and the third one is a bond trading at a discount, and just showing some examples of how they could equate to the same current yield based upon various market prices and differential nominal yields. Now that we've covered current yield as well as nominal yield, third one we're going to talk about is yield to maturity, or YTM. Now, what does it consist of? Well, yield to maturity consists of basically 3 things. Number 1, and a lot of times we refer to it as the total return or total yield. It consists of, number 1, the semi-annual interest payments one receives when purchasing a bond. 2, the interest earned from reinvesting those coupons. So, for example, if there's a 5% bond and I have a $1,000 5% bond and receive $50 per year, every 6 months I get $25. Well, the assumption is I take those $25 checks, I don't spend them, I reinvest, I put the money in a bank or some interest earning deposit. So number 2 is the interest earned from reinvesting those coupons. And 3, any gain or loss on the difference between the value of what I paid or the current value and the par value. So for example, if I paid $1,050, I'm only going to receive $1,000, this is a $50 loss. If I paid $900, that extra $100 I make at maturity is the third part of the differential. Now, in addition to that, the term yield to maturity, sometimes referred to as the basis or the basis points. The terminology is sort of a measurements. When we measure the value of a change in the price of a bond, we use the word points, half a point, quarter of a point, point and a half. When we refer to the change in the yield of a bond, we refer to basis points. So basis points represent 1/100th of 1%, and there are 100 basis points in each percent. So if someone said the value of a bond is 7%, then it goes to 8%. From 7% to 8% would be 100 basis points. So the other term is many market professionals, instead of saying what's the bond trading at, they wouldn't say, oh, a 4.6% yield. They simply refer to the terminology as it's trading at a 4.60 basis or 460 basis, which means it's trading at a price which is equivalent to a yield to maturity of 4.60%. It's pretty interesting. The other way you use the terminology is if one has a bond that's trading at 460 basis and there's another bond trading at a yield of 4.75%, instead of saying, well, it's higher by 0.15, we say it's trading at 15 basis points higher. If it was trading at 4.50, it'd be trading at 10 basis points lower. So it's just a unit of measurement. I mean, think in everyday life, if one was to walk into a bank and try to borrow funds, and they said, well, we're going to charge you 3%. And you say, well, 3% is too high. You go to another bank and they say, we're going to charge you 2.70%. You say, oh, one bank is charging me 3%, the other bank is charging me 2.0%. That's a reduction of 30 basis points. It's simply terminology, and we need to be comfortable with this terminology when we're answering examination questions. Now that we've talked about the various yields, please go to your workbook and complete the yield activity. We're going to read each statement, and then we're going to ask you to fill in the blanks. Let's do that now. A bond's nominal yield is also referred to as its coupon rate. So nominal yield and coupon rate or annual interest rate all refer to the same thing. Number 2, to calculate a bond's current yield, an investor must use its blank interest payment. What interest payment do you use to calculate current yield? And that would be the annual interest payment. You'd use the annual interest payment, not semi-annual interest payment. Number 3, to calculate a bond's current yield, the blank of the bond is used, not the investor's blank. What is used? The current market value is used, not the investor's purchase price. So I purchased the bond at $920. That's irrelevant. The current yield will constantly change based upon the current price. So I bought the bond at $920, but the current price is $990. I'd use the $990 to calculate the bond's current yield. Number 4, a bond's yield to maturity is also referred to as its blank or blank. What are some other terms for a bond's yield to maturity? The other 2 names are basis or just simply yield. It's trading at a 460 basis. It's trading at a 720 basis. What's the bond's yield? When someone says what's the bond's yield, they're generally referring to the yield to maturity. Number 5, 1.20% is equal to blank basis points. So how many basis points do we have if we have a term that has 1.20%, that would be 120 basis points. Each percentage point is 100 basis points. And lastly, number 6, if interest rates are increasing, bond yields are blank and bond prices are blank. So if interest rates are rising or increasing, what is happening to the yields of various bonds and what is happening to prices? Bond yields will be increasing and bond prices will be falling or decreasing. Before we get to some of the examples on the next few slides that deal with sort of like how to guess what one is when you know other information, how to guess the yield if you know the price, or the price you know the yield, let's review again the inverse relationship between interest rates and bond prices. Market prices would decline if what happened? If market interest rates increased. If that happens, the current yield would increase and the yield to maturity would also increase. But notice how the yield to maturity is always going to be higher than the current yield if the market price of the bond falls and is trading at a discount. If we reverse it, if market price was increasing, that would be caused by market rates or interest rates declining. And when that happens, the current yield would also fall and the yield to maturity would also fall. But notice how the current yield is always in between the nominal yield and yield to maturity, whether the bond's trading at a discount or a premium. Let's use this information to answer the next few questions. Let's look at a few examples of price versus yield, and we'll fill in some blanks. This is a sort of an exercise of how to answer examination questions when given certain pieces of information and asked for the price, the coupon, the yield. And you can do this in many cases without using any mathematical calculations or any use of the calculator, or maybe just very small one or two simple examples. So we have here a yield to maturity of 7.75%, a price of 102 or a premium, 1,020. We don't know what the coupon is, and we're given 3 choices. 1 is 8%, 2 is 7.75%, and 3 is 7.650%. Now then we have the par, the nominal yield, the current yield, and yield to maturity, assuming the bond's trading at par, but this bond is not. It's trading at a premium. So let's look at that. We know that if market prices are above 1,000, such as 1,020, that interest rates in general will be falling or have fallen. So we know that the yield to maturity is 7.75%, and we know the price is 102, and we're asked to find the coupon or nominal yield. So let's take it a step further. We don't know what that is, so we put a question mark there. Well, we know that the yield to maturity is 7.75%. The nominal yield must be higher than that. Well, how many choices are higher than 7.75%? Only 1. So we know the nominal yield or coupon rate must be 8%. Notice how we did this without using any calculations or any calculator, just knowing where the yields fall. So knowing that the nominal yield, the current yield, and where the yield to maturity falls can help us answer this question. Let's look at another one. We have here a current yield of 8.45%, a yield to maturity of 8.25%. We don't know the price, and we're given 3 choices. One is 98.5, the other one is 100 or par value, and the third one is 103 7/8. So we have a discount, par value, and a premium price. Let's go back to the seesaw or teeter-totter and see what happens. Well, we know that the yield to maturity is 8.25%, and we know the current yield is 8.45%, and what are we asked to calculate here is the market price. Well, we know if the yields are below the coupon rate, such as in this example, that the market price must be above par value. Since there's only one choice above par value, which is 103 and 7/8, that must be the answer. Again, a second way of answering the question without using any calculations. Now this next one is going to be a little bit more challenging. Let's look at that. We have here a coupon rate of 6%, a price of 95.50, and we're asked to find the yield to maturity, and we're given four choices: 5.85%, 6%, 6.25%, or 6.47%. Let's go back and do the same example. Well, we know the market price is below par value, which is $995. Again, 95.50 equals 95.50% of par, or $955. We know that the yield to maturity must be higher than the coupon rate. So we know the coupon rate is 6%. But in this case, we have two choices above 6%, 6.25% or 6.47%. Now, some people might just pick the higher one, which could be the correct answer, but let's do the calculation that we need to do in order to answer this question correctly. Let's do that now. Well, we know that the yield to maturity is above the current yield, and we do have enough information to calculate the current yield. So let's calculate the current yield to help us answer this question. So we know the coupon rate is 6%, or $60 per year. If we take $60, which is the annual interest payment, and divide by the current market price of $955, we get 6.28%, which is the current yield. Well, we know the yield to maturity has to be higher, not that much higher, but somewhat higher than 6.28%, since there's only one choice above that, and it's relatively, not 9%. We know that's the correct answer, which is 6.47%. So again, in this one, we had to do a little bit of math, but generally speaking, the yields work like this. It's on a bond trading at a discount, it will be the nominal yield, the current yield, and the yield to maturity. And if a bond's trading at a premium, it's the exact opposite. We generally have discussed four yields of a bond. You have the nominal yield, the current yield, the yield to maturity, and the yield to call. Now, the yield to call would only be relevant in two circumstances. One, that the bond is callable, and two, the entire issue of the bond is callable. Not certain parts, but the entire issue is callable, otherwise known as an in-whole call. A whole meaning W-H-O-L-E, that means the entire issue is callable. So the question is, if a bond is callable, how do the yields work? How can we show the yields if a bond is callable? Let's do that now. Well, we know that if a bond's trading at par, we have nominal yield, current yield, and yield to maturity all the same, and the same is true for current yield. So all four yields will be the same if the bond's trading at par. And again, we're also assuming the bond is callable at par, not at a premium. If the bond's callable at a premium, there would be a different calculation, which is generally beyond the scope of the examination. If a bond's trading at a discount, as we discussed earlier, we have the nominal yield, then the current yield, then the yield to maturity. But where would the yield to call fall if the bond is trading at a discount? Well, if the bond's trading at a discount, the yield to call will be higher than the yield to maturity. So when bonds are callable at par and selling at a discount, we use the yield to maturity. Why? Because it's the more conservative or lower of the two. Now, why is it lower? Well, here's why. If we buy a bond at a discount and the bond is maturing in 30 years and we buy the bond at $900, we're going to receive that $100, that differential between $900 and $1,000, in 30 years. If that same bond is callable in 5 years, instead of waiting 30 years to receive the extra $100, I'm only waiting 5 years. And the concept is, when you're making money, it's always more profitable to make money sooner or quicker and lose money over a much longer period of time, and that helps to answer this concept. Now, what if the bond is trading at a premium? Let's look at that. If a bond is trading at a premium, the market price is above the par value. And from earlier discussions, we have the nominal yield, followed lower by the current yield, followed by the yield to maturity. Well, if the bond is callable at par, the yield to call will be lower than the yield to maturity. Again, why? Because if you buy a bond at 1,000, let's say 50, and you're overpaying by $50, which you're going to lose at maturity, you paid 1,050, you're going to receive 1,000 at maturity. That extra $50, if we're losing that money over a quicker period of time, it's worse. And if we're losing that money over a longer period of time, it's preferred. So if a bond is selling at a discount, we always use the yield to call. So again, to summarize, premium bonds, nominal, then lower, current, then yield to maturity, then yield to call. And again, bonds trading at a discount will be the exact opposite. Let's move on to a different concept. For both equity and debt, let's discuss cost basis and capital events. The cost basis is the price of ownership. If I bought a security, what's my cost basis? If I sell a security, that's called sales proceeds. Now, generally speaking, if I buy a security, I'm going to pay a commission or some type of markup. In that case, the actual cost basis includes that. So the amount of commissions would be added to one's cost basis. Capital gains. Capital gains is based upon trade date to trade date. Capital losses would also be based on trade date to trade date. If I bought a security, that's my cost basis, including commissions and fees. If I sell it at a higher price, that's a capital gain. If I sell it at a lower price, that's a capital loss. Short term is defined by the IRS. Long term is defined by the IRS. If I held the asset for more than a year, it's long term. If I held it for a year or less, it'd be short term. Short term gains are taxable at the same rate as I pay ordinary income. So whatever my ordinary tax rate is on my salary and things like that is the same rate. If I sell it after holding it a year at a gain, the maximum rate is 20%. And there might be some added Social Security costs and things like that, but for the scope of this exam, two facts. One, long-term versus short-term. Two, the ordinary rate would be higher than 20%. And what I mean by the maximum rate is, if you were in the highest tax bracket, the maximum rate on the capital gain would be 20%, but your ordinary tax rate would be well over 20%. I always like to say it's better to make money, always good to make money. If you're going to make money, make it over a longer period of time because the rate on the tax is less. You're not taxed on appreciation. If you buy a stock at 20 and it's currently selling at 30, that's called depreciation, not a gain. Sometimes people call it realized versus unrealized gains. So if I buy something at 20, including commission, let's say, and it's trading at 30, that's an unrealized gain. If I then sell it at 30, that's a realized gain. Lastly, capital losses. Same concept, long-term or short-term, but if I sell it at a lower price. So if I buy an asset at 20 and I sell it at, let's say, 15, that's a capital loss of $5. It's always better to make money, but if you're going to lose money, again, capital losses are both long-term and short-term. Now, theoretically, this concept gets much more complicated, but for the purpose of the SIE, Securities Industry Essentials examination, we only have to know the basics of this information. Now, lastly is the term return of capital. Return of capital is a fancy way of saying getting your own money back. So if I buy a security and they give me a return of capital, that's not taxable. It's simply a fancy way of saying get my own money back. It doesn't occur in many investments. It might in some later investments. In another chapter, we'll talk about something called DPPs, or direct participation programs, where you're getting part of your money back. In mortgage-backed securities, which was discussed in one of the previous chapters, we talked about getting return of capital or return of principal. It's simply a fancy way of saying getting one's own money back. Now let's take a minute and answer the following question in your workbook. Question is as follows. As it relates to cost basis and capital events, which of these statements is or are true? Circle all that apply in your workbook. And there are 4. Number 1, cost basis is equal to the amount paid for security less commissions. Number 2, the sale of a security held for more than 1 year results in a long-term capital gain or loss. Number 3, the holding period of a security is measured from trade date to trade date. And last, number 4, any amount of the original investment received by an investor is considered a return of capital. Which of these 4 statements is true? And the answer is 2, 3, and 4 are all true. The sale of a security that's held for more than 1 year results in a long-term gain or loss. If it's held for a year or less, it's short-term gain or loss. The holding period of any security is measured from trade date to trade date, not settlement date. And lastly, any amount of original investment received by an investor is considered a return of capital, or simply a fancy way of saying getting your money back, or return of your capital. Number 1 is incorrect because it states that it subtracted the commissions. Well, and that's not true. Cost basis would be equal to the amount paid for security plus commissions, not minus commissions. If we sell a security, we have something called sales proceeds, which is the amount received, and that would be less commissions. So when you pay for something, you add commissions, and you receive money for a security sold, you subtract commissions. Now let's look at the concept of total return. Now the total return generally refers to all cash flows, which refer to dividends and interest, not stock dividends, cash dividends, plus any appreciation in the value of those securities, or minus any decline or depreciation in the value. Now the formula for total return is the ending value of the asset less the beginning value of that asset, adding investment income, interest or dividends, divided by the beginning value. Now notice how the term total return doesn't refer to a time period. It doesn't say yearly return, semi-annual return. The key word there is total return. Let's do an example. An investor purchased ABC preferred stock 2 years ago for $25 per share. Over this time, she's received $5 in dividends, and the stock is currently trading for $30 per share. What is this investor's total return on the investment? Let's not make this any more difficult than it is. Let's look at the example. Formula is, as we talked about earlier, ending value less beginning value plus income divided by beginning value. Now, $30 less $25 plus 5 divided by 25. Those are plugging in the numbers. Notice how that $5 of dividends is not per year, that's total dividends over that 2-year time period. Take the $5, add the $5, the differential between the 30 and 25, divided by 25. We get 10 divided by 25, or a total return of 40%. Now, if the stock went up after a year, and let's say you only received $2.50 of dividend, you don't have a total return yet, theoretically, because you didn't sell the asset. If you sell the asset, then you can calculate, you can say a theoretical value, because remember, if you buy something at 30 and it goes up to 40, you didn't make any money, that could easily drop down. So this is an example for the purpose of the SIE exam. We are asked to calculate the total return. Don't make it any more complicated than it is. Just follow the formula, plug in the numbers, look for the correct choice as one of the 4 choices in the exam, pick it and move on. Let's look at measuring investment returns. There are going to be 3 of them, and one of them is actually going to be built upon the other. The 3 terms are real rate of return or adjusted inflationary rate of return. 2, the risk-adjusted return. And third, the risk-free return. Let's look at the first one, real rate of return, inflation adjusted. That is found by taking the rate of return, what you're earning, less inflation. Now, inflation is usually measured based upon something called the CPI, Consumer Price Index, which will be discussed more in detail in Chapter 19, the economics chapter. So let's look at an example. If one said my return on the investment, let's say, is 8%. If inflation is 3%, my real rate of return would be 5%. Now, if I had that same rate of return of 8% and inflation, let's say, theoretically was 1%, then my real rate of return would have increased to 7%. So the idea is you want to beat inflation by a high amount, because if your return was 3% and inflation was 3%, you'd have a zero rate of return after adjusting for inflation. Number 2, risk-adjusted return. That is the rate of return less the risk-free return. So if my return was 8% and my risk-free return was 2%, 8 minus 2 is 6, my risk-adjusted return would be 6%. Well, where does the term risk-free return come from? Though that's the third item. And the risk-free return is generally the return or rate found in treasury bills, which is a risk-free security because the U.S. government has no credit risk. So the example I used before of 2% was based upon a treasury bill rate of 2%. So if my return, let's say, was 10% and the treasury bill rate was 3%, my risk-free return would be the 3%. My risk-adjusted return will be the difference between 10 and 3, or 7%. So those are some of the terms one needs to know when it comes to measuring returns. The questions on the exam won't be calculation questions, mostly conceptual questions. And if you have to do any math, it's a simple subtraction. Let's do a question now. Here's our scenario. A security has a 6% rate of return, while the inflation rate, or CPI, Consumer Price Index, is 1.5%, and T-bills are yielding 2%. The reason why I keep using the term CPI inflation is on the examination, they may use those terms interchangeably. One question might have the word CPI, another question might have the word inflation. So, again, inflation is 1.5%, T-bills are 2%. Here's our two questions. Number 1, what is the real return, or real rate of return? And 2, what is the risk-adjusted return? Let's take a minute or two and do the calculation in our workbooks. Okay. The real or inflation-adjusted return would be the rate of return less inflation. If we take the 6%, we subtract 1.50%, the real rate of return will be 4.5%. The risk-adjusted return would be the same return of 6%, less the treasury bill rate of 2%, which is the risk-adjusted return of 4%. Now, conceptually, if we go back to the real rate of return, if our return was 6% and CPI increased from 1.5 to, let's say, 2.5, the real rate of return would decline. So if we keep the same level of return and we increase inflation, the real rate of return would drop. Reverse. If we kept that 6% return and inflation dropped from 1.5 to, let's say, 1%, our real rate of return would increase. Now let's discuss the exciting world of indexes or indices and averages. So when people say how's your portfolio doing, it's up 10%, it's up 20%, it's up whatever, usually base it upon a benchmark or what we're comparing it to. Is it equity? Is it fixed income? What do I own? Now the term narrow and broad base, a little bit deceiving. The term narrow and broad base doesn't refer so much to the number of stocks. It refers to what those stocks are following. And by the way, this slide here, we're only discussing equities, stocks. So narrow base follows a sector where broad base follows the general market. So there could be an index or an indice of 50 or 100 stocks, but they only follow banking or technology or software. So even though there could be a great number of stocks, since they follow a specific sector, we call that a narrow-based index. And there are numerous narrow-based indexes out there in the marketplace. Now, broad-based could be 20 stocks, 30 stocks, or 500 stocks. But they tend to follow the general market. Well, two of the most popular are S&P or Standard & Poor's and Dow Jones. Let's take a careful look at those now. Now, the S&P 500 is one of the most widely followed indexes there is. A lot of people bench their returns or compare their returns against the S&P 500. And it made up of 400 industrial companies, 20 transportation, 40 utility, 40 financial. So the S&P 500 is predominantly industrial companies. The second broad-based one is the Dow. Now, the Dow Jones Composite is actually 65 companies made up of the industrials, transportation, and utilities. Now, of those, in fact, pretty much most people follow either the S&P 500 or the most widely followed is the Dow. Someone says, hey, how's the market doing? Many professionals referring to the Dow. Hey, the Dow's up 50 points. The Dow's up 25 points. The Dow went up by 100 points, whatever the case may be. Or the Dow Jones just broke a new record of 25,000. They're actually referring to the Dow Jones Industrial Average, which is 30 of the most popular stocks. IBM, Apple, Goldman Sachs, Disney, Hewlett-Packard, a number of different large companies that are well-known household names. JP Morgan is part of the Dow as well. And again, most people refer to the Dow, so even though it has a large number of companies, a large sector, broad sector, the number of companies is not that large. A few more equity indices are the Wilshire Associate Equity Index, or the Wilshire Index, which used to be called the Wilshire 5000, because it had 5,000 stocks. It is the most broad-based there is, the greatest number of stocks. In fact, if you owned a portfolio that followed the Wilshire Index, you'd basically own almost every stock or comparison. The Russell 2000 is a company based, Russell, like Wilshire is another company. They have an indice that focuses primarily on small cap stocks or stocks that have a lower capitalization value. There's also the NASDAQ composite. And then there's a last one called the NASDAQ 100, which is represents 100 of the largest companies in the NASDAQ index or the NASDAQ market. So, many different market indices. There are many mutual funds that follow these various indices. There are a number of bond indexes. Barclays and Merrill Lynch have a few. There's one specifically, make a note, it's not on the slides, just to make a note of it, please. There's a newspaper or a publication that's online or print called The Bond Buyer. And The Bond Buyer is a well-known publication in the municipal bond market. And they have various numbers of bond buyer indexes. So the bond buyer index mainly covers municipal securities. Now, lastly on the slide is something called tracking performance. And if someone says, how's your portfolio doing? Well, you want to measure your portfolio against the benchmark. So if your investment is up 5%, but the S&P is up by 10%, and you have a large cap portfolio, you may think you're doing well, but you're not doing well. In fact, you're not even equaling the market. So if you had a broad-based portfolio, you'd want to target performance based upon the S&P 500. So if the S&P 500 was up 10%, but your portfolio was up by 15%, you're beating the market. You're beating the benchmark. Look, it's the same thing in like certain education. You know, you get a grade, and your grade is X. And you want to say, okay, my grade is X, but how did I do as compared to my peers? Did I beat my peers? You know, I might have gotten a 90, but if everyone else got a 95, I didn't do that well. That's what benchmarks are all about and tracking performance. These averages or indices are used to compare one's portfolio value, increasing or decreasing, against some benchmark. The benchmarks there are these various indices. Well, I hope you enjoyed Chapter 6. We're going to move on now to Chapter 7, which covers one of the other products we need to talk about, or packaged products, which are mutual funds. What are the benefits of mutual funds? What are the structure and the various types of mutual funds, as well as the charges, the fees, and methods of purchasing the various mutual funds, and certain other types of investment companies will also be discussed.